Alright, if you've been searching the internet looking for information on how to use life insurance to invest in real estate, you've come to the right place. As you've been doing your research, you've probably come across strategies like infinite banking, bank on yourself, be the bank, 7702 plans, and all of them are giving you their marketing hype. They're telling you that it's got to be done with whole life from a mutual company that has a long history of paying dividends. And then you might have also come across information on indexed universal life. And people are telling you that that's the best approach to take. And then you've got the people out there that are telling you shouldn't do any life insurance. You should be doing buying term and investing the difference. Well, you've come to the right place, so stick around after the intro and we'll break it all down for you. We'll decide based on the facts which product is best for infinite banking, bank on yourself, the double play as I call it, index universal life, or whole life. So stay tuned and we're going to break it all down for you. Alright, I'm Tom Rutkowski. I gotta confess, I'm a bit of a financial nerd. Things like interest rate arbitrage and compounding interest fascinate me. And I discovered long ago that life insurance was one of the most powerful things that I could do to accelerate my own wealth accumulation. And now I want to share those secrets with you. So my goal with this video series is to demystify life insurance and give you the tools that you need to go out and design or have designed for you the most efficient cash value policy that you can possibly build so that you can streamline and optimize your real estate investing activities so that you can build more wealth over the course of your lifetime. So stay tuned and we're going to break it all down for you. So let's take care of some formalities. Nothing in this presentation constitutes financial or tax advice. And the primary reason for purchasing life insurance is for the death benefit protection. Any other benefit is ancillary. The purpose of this content is simply to show you how to do or how you can do what you were already looking for information on while you're doing your search on the internet. Alright, so as you've been doing your research, you've no doubt come across the names of strategies like infinite banking, bank on yourself, be the bank, 7702 plans, private banking, private family banking, and the one thing that all of these strategies have in common is that they're all based on the idea of leveraging the cash value of a life insurance policy. And what you're looking at on screen now is an extract from the Florida statutes that deal with life insurance, and specifically the statutes that deal with policy loans. So the thing that makes all of these strategies work is the fact that it's required by statute that insurance companies make loans to policy owners secured by the cash value of those policies. So I'm not a lawyer, I'm not giving tax advice, but I've got the statutes up on screen and I've kind of blocked out or patched together one complete sentence from what you can see there that basically says exactly what I just said. That is, the life insurance company must make loans to the policy owner with the cash value serving as collateral for those loans. One thing you're not going to see there is that it's got to be either whole life or index universal life. This applies to all permanent life insurance contracts. And this is the magic that makes this happen, because you can get a loan from the insurance company, or you can take your account value statement to a bank and get a line of credit secured by your cash value that you can turn around and use to invest. All right, so before we get started with analyzing whether or not whole life or index universal life is better for private banking strategies, we need to talk about some of the basics first. So life insurance is a complicated enough product with all the moving parts in it, so we need to cover a lot of what I consider life insurance 101 first to set the foundation to give us the tools that we can use to analyze which is better. Again, whole life or index universal life. Alright, so let's get into life insurance 101. The first thing we got to do is talk about cash value. I know from personal experience when I'm talking to potential clients that most people don't understand what the cash value of a policy really represents. So we've got to talk about that. And then we've got to talk about the differences between whole life and index universal life so that you really understand what it is that people are referring to when they tell you to use one and not the other, or vice versa. And then finally, once we've got that accomplished, then we can start looking at the actual numbers and data and decide which one is truly better for private banking strategies like infinite banking. All right, so we need to start with the cash value because a lot of people just simply don't understand what the cash value of a policy represents. And the answer is very simple. The cash value of a policy is literally the policy owners saving up their own death benefit over the course of their natural life expectancy. So if you put yourself in the position of the insurance company, they're designing a product or selling a product that basically says, let's just say the client is 45 years old and wants $1 million death benefit policy. The insurance company knows that they are going to have to pay $1 million someday, regardless of how long that person lives. They could step off of a curb tomorrow and be hit by a bus, or they could live to be 100. But they know they're going to have to come up with $1 million. So you kind of got to step back and put yourself in the position of the insurance company. If it was you, how would you design a policy like this? Well, certainly you'd want to design the premium such that over the course of that person's lifetime, some amount of that premium is going into a savings account where that money is being invested and it's growing and compounding and will eventually reach the $1 million, hopefully by the time they reach their natural life expectancy. This graph is showing a life insurance policy. So the curve that's sweeping up and to the left represents the cash value starting at low and growing over time to the point where it reaches the death benefit of the policy. And the death benefit is shown as the horizontal line up at the top. So at any given time, if the person were to die, the insurance company is on the hook for the difference, as the brackets are showing, between the cash value and the death benefit. So over time, as the client ages, the cash value is accumulating and the risk of the insurance company is going down. So the thing I want you to keep in mind here is that the insurance company has an incentive for the cash value to grow as quickly as possible, because the faster the cash value grows, the quicker their risk is eliminated. And you can see that if in this chart that blue curve were increased to the point where closer to the death benefit, well then the insurance company's risk, right? So what I want you to keep in mind here too is that this is a minimally funded life insurance policy. This is the complete opposite of what we're using for these personal banking strategies, private banking strategies. But what I want you to understand is the basics, that this is what a policy looks like, the moving parts of the policy, what the cash value represents. Another way to think of a minimally funded policy is to think of calling up an insurance agent and asking for a quote on $1 million whole life policy. Well, that agent knows that you're going to shop that policy around, so they want to offer you a price that's as low as possible to remain competitive with all the other companies that are out there. So they want to collect as little premium as they possibly can, but still meet the obligations of the policy, because at any given time, they know that the interest rate could go down and they may not earn as much on the cash value over time. So they need to do their planning with some worst case planning scenario when they price that policy. If it does better, that's wonderful. That's all money that is in the cash value and goes to eliminating the risk to the insurance company. But if it goes bad, they want to just make sure that it never gets bad enough that they're on the hook for that. So when companies talk about the guaranteed rate of interest, all that guarantee really is the worst case planning scenario that they don't really expect to happen. They expect to invest in the markets and do as well as they possibly can. The guarantee just represents the number that they're willing to put their name on and stand behind. So the world that I live in is overfunded life insurance policies, and we're going to look at that here in a second. This client is funding the policy over a period of 10 years. And we've designed it so that it's got the minimum death benefit to the maximum cash value. And one thing to keep in mind, and is very important, and we'll circle back to this in future videos, is the death benefit of the policy is a function of the first year premium, not the premiums that come after it. So when you see the cash value and the premium, or the death benefit on this chart, you're looking at the minimum amount of death benefit associated with that first level of premium. So that first, it's almost impossible to see from the graph here, just because of the scale. But of that initial premium, about 85% of it is going towards cash value. So if the premium is $100,000, there's probably about $85,000 worth of cash value there that the client could borrow against to do whatever they want to. And then each subsequent year, as the client adds more cash to the policy, that death benefit, because we set it to be a minimum, is being pushed up over time as the policy grows, as the cash value of the policy grows. So once the client has reached the 10th year and they don't want to make premium payments anymore, what you're seeing on the graph is we're making a change to the policy, because the death benefit is where the costs are. It costs money that the insurance company has to pool in order to cover the risk that they have to come out of pocket to pay that death benefit. So they do that by pooling. In the case of a whole life company, they literally take from the premium or from the cash value to put money into a pool to cover the expected benefits that they have to pay out. Because some 45-year-olds are not going to make it to 46. And they have a pretty good idea because they're all using the same actuarial tables of what that number is going to be. So the thing to keep in mind here is we're reducing the death benefit to the minimum non-MEC, whether it's an index universal life or whether it's a whole life. And once that change is made and the death benefit is reduced, you can see on the chart that the corridor, that little thin sliver between the death benefit and the cash value, is the only risk to the insurance company. So this is a much more efficient policy designed from the insurance company's perspective. They have very little risk now that you've saved up all that cash value and reduced the death benefit. And it's also good for you because that cash value is an extremely powerful tool. So going back to the fundamentals, just remember that the cash value is literally you saving up your own death benefit over the course of your natural life expectancy. And in this overfunded policy design, you can actually see that because as the cash value grows over time, it never quite reaches the death benefit. It's always got that little bit of sliver above it. So even if you live to be 85 years old, there's always a probability you can make it to 90. If you make it to 90, there's always that probability that you can make it to 91. So it's never quite getting there. But you see that the risk is getting thinner with every passing year. So two items of interest are going on here. One is the cost of that insurance is getting more expensive every single year to the insurance company because you're getting older. On the other hand, the amount of insurance needed, the risk of the insurance company, is actually going down. So what you find is that the cost of the insurance as a proportion of the cash value is actually less than 0.25% of the cash value in any given year. And that number is relatively constant from the beginning when you first make that change to the minimum non-MEC death benefit all the way through. It never really changes. So that busts one of the myths that you've probably heard on the internet already, that you don't want to buy a universal life because the rising cost of insurance will cause the policy to lapse. Look at this design. Do you see the amount of risk that's truly in that policy? And mind you, it's the same for a whole life as well. There's very little risk here. We've taken it all out when we do these high cash value policy designs. Now, in the minimally funded world, that might be more of an issue, but not here in the maximum overfunded life insurance policy world. All right, so one thing that you haven't heard me talk about so far as I've been showing you these graphs is which one's whole life, which one's index universal life. And the reason for that is it doesn't matter. They're both the same. And the thing I really want you to understand here is that under the hood, the insurance companies are doing the exact same thing. All of the premium that they collect, they're taking their fees out of it, of course, but all of the rest of that cash is being invested in bonds, treasuries. They buy tons of mortgages from the bank. So that money is just being invested. And the primary difference between an index universal life and a whole life is that the insurance company is literally taking the interest that they would have otherwise paid to you in the form of a dividend, and they're going out to the options market, specifically the index options markets, and they're just simply trying to buy it or hedge and buy as much movement in the market as they can get with the money that they have. So when interest rates go down, the cash value earns less and they have less to play with. So in today's market, you're finding that caps on index universal life are dropping. And that's simply a function of the fact that interest rates are dropping right now in the market as well. So a few years ago when interest rates were higher, you saw that the caps were higher on index universal life. So the worst case scenario with an index universal life is that the markets go down and you earn a zero. And whatever the cost of insurance is, which I said was about 1/4 of 1%, you would take a step backwards by that 1/4 of 1%. Your cash value would take a step backwards by that 1/4 of 1%. All right, so now that we've covered what the cash value of the policy represents and the primary differences between whole life and index universal life, and except for the way the dividends or interest crediting is done, I mean, they're really functionally the same. And all right, so let's take a look at two clients. Each one is identical. They're each 45 years old. They're each paying $50,000 a year in premium, and it works out to be $1 million life insurance death benefit on the policy. So whether it's whole life or whether it's an index universal life, the insurance companies are collecting the same exact amount of premium. And to the extent that they're charging the exact same fees, they're all taking the same amount of fees out of the cash value, out of the policy, the premium, and you've got the exact same cash value with which to make that policy perform. So both companies, one that does index universal life, one that does whole life, they're collecting the same exact resources, and they have the same exact obligations. So both of them have the same risk that if that person dies, that they have to perform on that policy and come up with the money to pay the death benefit. And as we discussed, they're both doing the exact same thing with that money. There's the cash savings component, and then they're going out and they're basically pooling funds to pay the expected claims. Or in the case of a universal life, they're quite literally buying a 1-year term policy. But it's the functional equivalent. It's just how you unbundle a universal life from a whole life. You're just putting a price on that mortality cost. So both types of policies are functionally identical. And as the client gets older, if both cash values earned exactly the same, both policies will face the same exact risks over time as well. All right, so now you're thinking to yourself, there's no difference between the whole life and the index universal life, so why don't I just go with the whole life because it's got a guarantee? Well, in the real world, they're not the same. And as I discussed, the whole point of an index universal life is not to capture an equity market type rate of return, it's simply to beat the debt market rate of return. The insurance companies found a way that they could increase the growth safely on the cash value. So index universal life isn't about giving a fancy tool to you, it's about making the cash value grow faster so that you are saving up your death benefit that much quicker and their risk is being eliminated. But as you can see from this chart, once we reduce the death benefit to the minimum non-MEC amount and we're maintaining that sliver, it really comes down to which policy, whole life or index universal life, is going to have the best potential for growth. Because if your goal is to leverage the cash value in your policy as your own personal line of credit or bank, well then more is better than less, right? And if the index universal life is capturing some of the equity premium, then we can expect that over time the cash value of that IUL is going to grow at a faster rate than the cash value of that whole life policy, which is based on the returns of the debt markets. Remember, the insurance companies are buying into the bonds and treasuries and mortgages, so they're earning a debt market rate of return and they're paying that out as a dividend. Whereas on the index universal life, they're hedging to try and capture a little bit of that equity premium. And they wouldn't do that if there wasn't an opportunity to earn a superior rate of return. So one big point that I really want to make in this video is not that it's the difference between index universal life and whole life that's going to make or break the bank. The most important thing that you're doing when you do the double play is the policy design. It's making sure that the policy is designed right to minimize the death benefit and keep the costs to an absolute minimum. That's where you're going to make money, or where you're going to lose money, because a bad policy design can literally cost you thousands of dollars and you'll never even know it because you don't understand life insurance like the agent does, or maybe even the agent doesn't know. I mean, that's a big concern of mine is I talk to people that have no idea, and they do things that cost clients money without even knowing that they did it. I see it in discussions on Bigger Pockets, which is a real estate investor community. People ask me to review their policies all the time, and this is the single biggest mistake that people make, and it can cost them thousands of dollars. So stay tuned to the end of the video and I'll show you how to get a copy of my paper, the single biggest mistake that people make when they get an overfunded policy design that can cost them thousands of dollars. Alright, so there you have it. Please let me know in the comments below whether or not you feel that I explained this with facts and data, or if you thought that this was hype and BS. I'd really like to know. Alright, I'd like to know how your video search has been going so far, if you've been finding information that's hype and BS, or hard facts and data. So go ahead and comment below. I'd like to see your comments and how your research has been going so far. And also, if you're hungry for more information on this, I'd like to let you know that my website is a treasure trove of information. I consider it to be a no-fluff zone. So there's tons of information available for you to view free of charge without talking to a life insurance agent. And you can get that there on the website. I also have a Facebook group for all of my clients and anybody who's interested in learning about the double play. So feel free to go there. The link is on screen and it'll be in the description at the bottom of the video. Go there, sign up. If you've got any questions, the members there are more than happy to answer questions about life insurance, because we're all passionate. It's a community of people who are doing this and are passionate about doing this and understand the power of doing this.